Something extraordinary just happened in the silver market. And if you're not paying attention right now, you're going to miss one of the biggest wealth-building opportunities of this decade. I'm talking about a technical signal that hasn't appeared in silver since 2020. The last time we saw this pattern, silver rocketed from $18 to $30 in just 4 months. That's a 66% gain. And the setup we're seeing right now? It's even stronger. Let me show you exactly what's happening. Silver just broke through a critical resistance level that's been holding it down for months. We're talking about the $32 level that's acted as a ceiling since May. For 7 months, every time silver tried to push through, it got smacked back down. Traders got frustrated. Retail investors gave up. The mainstream media stopped talking about it. But here's what they missed. While everyone was looking away, something was building beneath the surface. The smart money was accumulating. Central banks were buying. Industrial demand was surging. And the technical setup was coiling tighter and tighter, like a spring ready to explode. On December 12th, silver finally broke through. It didn't just tap $32 and fall back. It blasted through with conviction, closing at $32.15. The next day, it held. Then it pushed higher. As of today, December 17th, silver is trading at $65.58 per troy ounce. Wait, let me say that again because it's absolutely critical. Silver has more than doubled in the past week. It's up 123% from where it was just a month ago. This isn't a normal move. This is the kind of explosive breakout that creates generational wealth for those who position themselves early. And we're still in the early stages. Let me explain why this is happening, why it's going to continue, and what you need to do right now. First, let's talk about the technical picture, because this is where the buy signal becomes crystal clear. Silver has been forming what technical analysts call a double bottom pattern. This is one of the most reliable bullish reversal patterns in all of technical analysis. Here's how it works. The price drops to a certain level, bounces back up, then drops again to test that same level. When it holds that second time and starts moving higher, it signals that all the sellers are exhausted. There's no one left to push it lower. The only direction left is up. Silver formed its first bottom at $28.50 back in August. It rallied to $32, then fell back in November to test $28.50 again. That second test held perfectly, and when it did, the buying pressure that had been building for months finally overwhelmed the selling pressure. But here's what makes this setup even more powerful. While silver was forming this double bottom, it was also building a massive base of support. Think of it like a foundation for a skyscraper. The wider and stronger the foundation, the higher the building can go. Silver spent 7 months building this foundation between 28 and 32. That's an incredibly strong base. Now that it's broken out above $32, all that consolidation energy is being released. And the technical targets? They're stunning. When you measure the depth of the double bottom pattern and project it upward from the breakout point, you get a target of $50. That's not some wild speculation. That's basic technical analysis that's been proven over decades of market history. And given that we're already at $65, we've blown past that initial target. The next major resistance level? $75 to $80, which was the high from 2011. But the technical picture is just the beginning. The fundamental story behind silver right now is even more compelling. Let's start with supply and demand, because this is where things get really interesting. Silver is unique among precious metals. Gold is primarily a monetary metal. People buy it to store wealth, to hedge against inflation, to protect against currency devaluation. But silver? Silver is both a monetary metal and an industrial metal. And that dual nature is creating a supply crunch that most people don't understand yet. On the industrial side, silver demand is exploding. And I mean exploding. Solar panels require silver. Every single solar panel uses about 20 grams of silver in its photovoltaic cells. And with the global push toward renewable energy, solar panel production is skyrocketing. In 2023, solar panel manufacturers consumed over 140 million ounces of silver. This year, that number is projected to hit 160 million ounces. Next year, even higher. But it's not just solar. Electric vehicles use twice as much silver as traditional cars. Every EV contains about 25 to 50 grams of silver in its electrical systems, battery management, and charging infrastructure. And EV production is growing at 30% per year, 5G networks require silver. Medical devices require silver. Electronics, semiconductors, batteries, water purification systems. The list goes on and on. Here's the problem. Annual silver mine production is only about 830 million ounces, and it's not growing. In fact, many of the world's largest silver mines are seeing declining production as ore grades deteriorate. Meanwhile, industrial demand alone is consuming nearly 600 million ounces per year. Add in investment demand, jewelry, and silverware, and you're looking at total demand of over 1.2 billion ounces. Do the math. We're running a deficit of 370 million ounces per year. That deficit has to be filled from somewhere. And where is it coming from? Above-ground stockpiles, recycling, ETF liquidations. But those sources are finite, and they're running low. The Silver Institute just released their latest report, and the numbers are stark. Above-ground silver inventories have fallen by 40% over the past 3 years. The COMEX warehouses, where silver futures contracts are settled, have seen their inventories drop from 400 million ounces in 2021 to just 240 million ounces today. That's a 40% decline in the physical silver available for delivery. And here's where it gets really interesting. The ratio of paper silver to physical silver is estimated to be somewhere between 100 to 1 and 250 to 1. That means for every ounce of physical silver that actually exists, there are 100 to 250 ounces of paper claims on that silver through futures contracts, ETFs, and other derivatives. What happens when people start demanding physical delivery? What happens when industrial users who need silver for production can't get it? What happens when investors realize that their paper silver might not be backed by actual metal? You get a squeeze. A massive, explosive, short squeeze that sends prices vertical. And we're starting to see the early signs of that squeeze right now. Look at what's happening in the futures market. The commercial traders, the big banks, and institutions that typically short silver to hedge their physical positions have been covering their shorts at a record pace. In the last Commitment of Traders report, commercial short positions dropped by 15,000 contracts in a single week. That's 75 million ounces of silver. They're not covering because they want to. They're covering because they have to, because the physical market is getting too tight. Meanwhile, the large speculators, the hedge funds, and commodity trading advisors are building long positions. They smell blood in the water. They know a squeeze is coming, and they're positioning themselves to profit from it. But here's what really tells you this move is just getting started. Retail investors haven't shown up yet. The average person on the street has no idea this is happening. Silver isn't trending on social media. CNBC isn't talking about it. Your neighbor isn't asking you about silver coins. When retail finally wakes up and realizes what's happening, when the FOMO kicks in and everyone starts rushing to buy silver, that's when this thing goes parabolic. And based on historical patterns, we're probably 3 to 6 months away from that phase. Now let me talk about something that most analysts are completely missing: the monetary side of this equation. Central banks around the world are buying gold at record levels. In 2023, central banks purchased over 1,000 tons of gold. That's the highest level in over 50 years. Why? Because they're diversifying away from the US dollar. They're preparing for a new monetary system. They're hedging against the massive debt levels and currency debasement that's happening globally. But here's what's interesting. While central banks are buying gold, they're not buying silver, at least not officially. But the gold to silver ratio tells a different story. Right now, the gold to silver ratio is sitting at about 45 to 1. That means it takes 45 ounces of silver to buy 1 ounce of gold. Historically, that ratio has averaged around 60 to 1 over the past century. But if you go back further, to when both gold and silver were used as money, the ratio was 15 to 1. Think about what that means. If silver were to revert to its historical monetary ratio with gold, and gold is trading at $2,700 per ounce, silver would be at $180 per ounce. Even if it just reverts to the modern average of 60 to 1, silver would be at $45. But here's the kicker. With gold breaking out to new all-time highs, with central banks accumulating, with the monetary system in flux, silver is the leveraged play on gold. When gold moves 10%, silver typically moves 20% to 30%. It's more volatile, more explosive, and offers bigger percentage gains. And we're seeing that play out right now. Gold is up about 25% year to date. Silver? It's up 123% in the past month alone. The leverage is working exactly as it should. Let me tell you a story that illustrates why this matters. In 1979, the Hunt brothers, Nelson Bunker Hunt and William Herbert Hunt, started accumulating silver. They believed that inflation was going to destroy the value of paper currency, and they wanted to own hard assets. So they started buying, and buying, and buying. By 1980, they had accumulated over 100 million ounces of silver. That was roughly half of the entire world's deliverable supply. As they bought, the price of silver went from $6 per ounce to $50 per ounce in just a few months. It was one of the most spectacular bull runs in commodity history. Now, the Hunt brothers' story ended badly. They were using leverage, they got caught in a regulatory crackdown, and they eventually went bankrupt. But here's the lesson. When someone tries to corner the silver market, when physical supply gets tight, the price can move in ways that seem impossible. And right now, we don't have two brothers trying to corner the market. We have thousands of industrial users competing for limited supply. We have millions of investors waking up to the inflation hedge story. We have a structural deficit that's getting worse every year. The setup is even more powerful than 1980. And this time, it's not manipulation. It's fundamental supply and demand. Quick aside here, because this is important. If you're sitting on $100,000 or more in retirement accounts, you might want to look into how gold IRAs work. I put together a free guide that covers how to get physical precious metals into your retirement account without tax penalties. It's in the description below. Worth checking out if you're thinking about protecting your retirement savings with hard assets. Anyway, back to where this price is headed next. Let's talk about the geopolitical factors that are adding fuel to this fire. The BRICS nations, Brazil, Russia, India, China, and South Africa, along with several new members, are actively working to create an alternative to the US dollar for international trade. They're talking about a new currency backed by commodities, including gold and silver. Whether this actually happens or not is debatable. But the fact that they're talking about it, the fact that they're moving away from dollar-denominated trade, is significant. China has been accumulating gold for years. Their official reserves show steady increases, but many analysts believe their actual holdings are much higher than reported. Why? Because they're buying through back channels, through state-owned enterprises, through Hong Kong. They don't want to tip their hand. And if China is accumulating gold, you can bet they're accumulating silver too. China is the world's largest producer of silver, mining about 120 million ounces per year. But they're also the world's largest consumer, using over 200 million ounces per year in their massive electronics and solar industries. They're running a deficit of 80 million ounces per year domestically. What do you think happens when China decides they don't want to export silver anymore? What happens when they decide to keep all their domestic production for their own industrial needs? The global supply crunch gets even tighter. Russia is in a similar position. They're the world's fifth largest silver producer. And with Western sanctions cutting them off from dollar-based trade, they're looking to commodities as a way to back their currency and conduct trade with friendly nations. Silver fits that bill perfectly. India has a cultural affinity for precious metals. Silver jewelry and coins are traditional gifts for weddings and festivals. Indian silver imports have been surging, up 30% year over year, and with India's economy growing at 7% per year, that demand is only going to increase. So you have the world's three most populous nations, representing over 3 billion people, all increasing their demand for silver at the same time that global supply is constrained. That's a recipe for a price explosion. Now let me address the elephant in the room. The skeptics will say, but silver has been a terrible investment for years. It peaked at $50 in 2011 and then crashed. Why should this time be different? Fair question. Let me answer it. First, the 2011 peak was driven primarily by investment demand in the wake of the 2008 financial crisis. People were scared. They were buying silver as a hedge against the collapse of the financial system. But the industrial demand story wasn't as strong back then. Solar was in its infancy. EVs didn't exist. 5G wasn't even a concept. Today, the industrial demand is real and growing. It's not speculative. It's actual consumption that's not coming back. When silver goes into a solar panel, it's gone. It's not getting recycled. It's locked up for 25 years. Second, the supply situation is much tighter now. In 2011, there were still plenty of above-ground stockpiles. Miners could ramp up production relatively quickly. Today, those stockpiles are depleted, and mining production can't increase fast enough to meet demand. It takes 7 to 10 years to bring a new mine online. We don't have that kind of time. Third, the monetary environment is different. In 2011, the Fed was just starting its quantitative easing program. Today, we've had over a decade of money printing. The national debt has doubled. Inflation is persistent. The dollar's reserve status is being questioned. The conditions for a precious metals bull market are much more entrenched. And fourth, the technical setup is stronger. Silver has spent 13 years building a base. It's tested the $18 to $20 level multiple times and held. It's formed a massive cup and handle pattern on the long-term charts. When a market consolidates for that long and then breaks out, the moves are typically much larger and longer lasting than quick speculative spikes. So yes, silver has been frustrating for years. But that frustration is exactly what creates the opportunity. Everyone who was going to give up has given up. Everyone who was going to sell has sold. The weak hands are gone. What's left are the strong hands, the industrial users who need it, and the smart money that understands what's coming. Let me give you another historical parallel that's even more relevant. In 1971, President Nixon closed the gold window, ending the convertibility of dollars into gold. That was the end of the Bretton Woods system. It was the moment when the dollar became a pure fiat currency, backed by nothing but faith in the U.S. government. What happened to gold and silver after that? From 1971 to 1980, gold went from $35 to $850. That's a 24x increase. Silver went from $150 to $50. That's a 33x increase. It took 9 years, but the gains were absolutely massive. Why did that happen? Because the market realized that without gold backing, the dollar could be printed infinitely. And when you can print money infinitely, that money loses value. So people rushed into hard assets that couldn't be printed. Fast forward to today. We're in a similar moment. The dollar is losing its reserve status. Central banks are diversifying. The BRICS are creating alternatives. The debt levels are unsustainable. The parallels to the 1970s are striking. And if we're in the early stages of a similar bull market, if silver is going to move like it did from 1971 to 1980, then we're looking at prices that seem unimaginable today. Even a fraction of that move would take silver to $100, $150, $200 per ounce. Sound crazy? Maybe. But consider this. In inflation-adjusted terms, the 1980 peak of $50 would be equivalent to about $185 today. So silver reaching $150 or $200 wouldn't even be a new all-time high in real terms. It would just be catching up to where it's been before. Now let's talk about what you should be watching for in the coming weeks and months. First, watch the $70 level. That's the next major resistance. If silver can break through and hold above $70, the next stop is $80, which was the 2011 high. Once it clears that, there's very little resistance until $100. Second, watch the gold to silver ratio. If it starts dropping rapidly, if it goes from 45 to 1 down to 35 to 1 or 30 to 1, that's a sign that silver is outperforming gold and the momentum is accelerating. Third, watch the COMEX inventories. If they drop below 200 million ounces, that's a critical level. Below that, there's a real risk of a delivery default, which would send prices into the stratosphere. Fourth, watch the ETF flows. When you start seeing massive inflows into silver ETFs like SLV, that's a sign that institutional money is piling in. And when institutions move, they move size. That's when the real acceleration happens. Fifth, watch the mining stocks. Silver miners are leveraged plays on the silver price. When silver moves 10%, mining stocks can move 30% to 50%. If you see the mining stocks breaking out to new highs, that's confirmation that the smart money believes this move is real. And finally, watch the mainstream media. When CNBC starts running segments on silver, when your friends start asking you about it, when silver becomes a trending topic on social media, that's when we're entering the mania phase. That's when the biggest gains happen. But it's also when you need to start thinking about taking profits. But we're not there yet. Not even close. Right now, we're in the early stages. The breakout just happened. The technical signal just triggered. The smart money is positioning. And the general public is still asleep. This is the opportunity. Let me be clear about something. I'm not saying silver is going to go straight up from here. There will be pullbacks, there will be consolidations, there will be moments of doubt. That's how bull markets work. They climb a wall of worry, they shake out the weak hands, they test your conviction. But if you understand the fundamentals, if you understand the supply and demand dynamics, if you understand the monetary backdrop, then those pullbacks are buying opportunities. They're chances to add to your position at better prices. The key is to have a plan. Know why you're buying. Know what your time horizon is. Know what your exit strategy is. Are you buying for a trade, looking to flip it in a few months? Or are you buying for a long-term hold, looking to protect your wealth over years? Both strategies can work. But you need to know which one you're doing. If you're trading, then you need to watch the technical levels closely. You need to set stop losses. You need to take profits when the momentum starts to fade. Trading is about timing and discipline. If you're investing for the long term, then you need to focus on accumulation. Buy on dips, dollar cost average, build a position over time, and don't get shaken out by short-term volatility. Long-term investing is about patience and conviction. Personally, I think the best approach is a combination of both. Have a core position that you're holding for the long term, for the big move that could take years to play out, and then have a trading position that you're actively managing, taking profits on rallies and buying back on dips. That way, you're participating in the short-term moves, but you're also positioned for the long-term trend. You're not going to time it perfectly. Nobody does. But you'll capture a good portion of the move, and that's all you need to do very well. Now, let's talk about how to actually buy silver, because there are several ways to do it, and each has pros and cons. The most direct way is to buy physical silver. Coins, bars, rounds. You can buy from online dealers, local coin shops, or even directly from mints. The advantage of physical silver is that you own it outright. It's in your possession. Nobody can take it from you. It's the ultimate form of wealth insurance. The disadvantage is that there's a premium over the spot price. Depending on what you buy, you might pay 10% to 30% over spot. And when you sell, you'll get less than spot. So there's a spread. Also, you have to store it securely, which means a safe or a safety deposit box. And if you're buying large quantities, the logistics can be challenging. Another option is silver ETFs like SLV or PSLV. These are funds that hold physical silver and issue shares that trade on the stock exchange. The advantage is liquidity. You can buy and sell instantly. There's no storage hassle. The spreads are tight. The disadvantage is that you don't actually own the silver. You own shares in a fund that owns silver. There's counterparty risk. And some people question whether these funds actually have all the silver they claim to have. There have been controversies about whether the silver is allocated or unallocated, whether it's actually in the vault or just a paper claim. Then there are silver mining stocks, companies that mine silver. The advantage here is leverage. When silver goes up 10%, a well-run mining company's stock might go up 30% or 50%. The profit margins expand dramatically as the silver price rises. The disadvantage is that you're not just betting on silver. You're betting on the management team, the quality of the mines, the geopolitical risk of where they operate, the cost structure, the debt levels. A mining stock can go down even if silver goes up if the company has operational problems. There are also silver futures and options, but those are for sophisticated traders only. They involve leverage, margin calls, and expiration dates. If you don't know what you're doing, you can lose everything very quickly. My recommendation? If you're new to silver, start with physical. Buy some coins or small bars. Get a feel for it. Understand what you're buying. Then, if you want more exposure, add some ETFs for liquidity. And if you're comfortable with the risk, add some mining stocks for leverage. Diversify your approach. Don't put all your eggs in one basket. That way, you're protected against the specific risks of each method, but you're still fully exposed to the upside of silver. Here's the bottom line. Silver just triggered a massive buy signal. The technical breakout is confirmed. The fundamentals are stronger than they've been in decades. The supply and demand dynamics are setting up for a historic squeeze. The monetary backdrop is perfect for precious metals. And we're still in the early stages of what could be a multi-year bull market. This is not financial advice. I'm not telling you to buy silver. I'm showing you what's happening and why it matters. You need to do your own research. You need to understand your own risk tolerance. You need to make your own decisions. But if you've been waiting for a clear signal, for a moment when the risk-reward is heavily skewed in your favor, this is it. The breakout just happened. The momentum is building. And the opportunity is right in front of you. Don't let this pass you by. Don't be the person who looks back in 6 months or a year and says, I knew about that. I saw it coming. But I didn't act. The time to position yourself is now, while silver is still under $70. While the mainstream hasn't caught on yet. While you can still get in before the real mania begins. Because once this thing goes parabolic, once retail investors pile in, once the squeeze really gets going, the prices you're seeing today will look like a gift. You'll wish you had bought more. You'll wish you had acted sooner. So take action, do your research, make a plan, and position yourself for what could be one of the biggest wealth-building opportunities of this decade. The signal has been triggered. The move has started. The question is, are you going to be part of it?